William Ackman, founder of Pershing Square Capital Management, is a name synonymous with high-stakes activist investing. For decades, he has captivated the financial world with his bold claims, meticulous research, and sometimes controversial, highly concentrated bets. From challenging corporate boards to making billion-dollar short calls, Ackman's career offers a masterclass in conviction-driven finance. This video delves into his unique approach, analyzing his most impactful trades, both triumphs and tribulations, and extracting the critical lessons for navigating the complex world of investing. We'll explore how his strategies have shaped companies and influenced market dynamics, providing a deep dive into the mind of one of Wall Street's most distinctive figures. Ackman founded Pershing Square in 2004, building upon a reputation forged through earlier ventures. His investment philosophy quickly crystallized: identify undervalued companies, acquire a significant stake, and then actively push for strategic changes to unlock shareholder value. This isn't passive investing, it's a hands-on, often confrontational approach. Ackman believes in deep fundamental research, concentrating capital in a select few high-conviction ideas, and holding them for the long term, sometimes for years. This focus on operational improvement rather than just market timing distinguishes his strategy from many peers. Ackman's activism isn't merely about buying shares, it's about engineering change. His team conducts exhaustive due diligence, often identifying operational inefficiencies, misaligned management incentives, or overlooked asset values. Once invested, Pershing Square often engages with management and boards, sometimes publicly, to advocate for specific actions, divesting non-core assets, optimizing capital structure, or even replacing leadership. This proactive engagement, backed by substantial ownership stakes, grants him considerable leverage. It transforms him from a mere shareholder into a powerful catalyst for corporate transformation, aiming to boost intrinsic value for all shareholders. One of Ackman's most celebrated successes was the transformation of Canadian Pacific Railway. In 2011, Pershing Square acquired a significant stake and initiated a proxy battle to replace the CEO and several board members. Ackman argued the company was underperforming its potential due to inefficient operations and poor management. Despite initial resistance, his persistence paid off. After installing a new leadership team, including CEO Hunter Harrison, CPR underwent a dramatic operational overhaul. The results were staggering. The company's stock price surged by approximately 150% over the subsequent years, validating Ackman's activist approach and delivering immense value to shareholders. Ackman's activist strategy stands in stark contrast to passive investing, where funds simply track an index without engaging with company management. While passive investing offers broad market exposure and low fees, it lacks the mechanism to directly influence corporate performance. Activism, though higher risk and resource-intensive, aims to generate alpha by unlocking specific, identifiable value within individual companies. Pershing Square's deep dives and direct interventions represent a belief that market prices don't always reflect intrinsic value, and that skilled intervention can close that gap. This divergence highlights a fundamental debate in modern finance. Not all of Ackman's high-conviction bets have paid off. The short position against Herbalife International stands as perhaps his most notorious challenge. Beginning in 2012, Ackman publicly declared the nutritional supplement company a pyramid scheme, investing over $1 billion to short its stock. He waged a multi-year campaign, presenting extensive research and lobbying regulators. However, despite his conviction and the public spectacle, Herbalife stock largely defied his bet, bolstered by rival investor Carl Icahn's long position. Ackman eventually exited his position in 2018, reportedly incurring significant losses, marking a painful and public defeat. Another high-profile setback for Ackman was his investment in Valeant Pharmaceuticals. Pershing Square became a major shareholder in 2015, attracted by Valeant's roll-up strategy of acquiring drug companies and then steeply raising prices. Initially, the stock soared, but scrutiny intensified over its business practices and accounting. When a major pricing scandal erupted and government investigations loomed, Valeant's stock collapsed. Ackman initially defended the company but ultimately divested his stake in 2017, taking billions in losses. This episode underscored the immense risks of concentrated bets, even when backed by thorough initial research. The Herbalife and Valeant sagas offer crucial lessons in investment humility. Even the most rigorous analysis and strongest convictions can be wrong or encounter unforeseen headwinds. Ackman himself has spoken about the emotional toll and the importance of learning from mistakes. These episodes illustrate the dangers of an overly concentrated portfolio when a bet turns sour, and the power of market narratives and regulatory risks to override fundamental analysis. For investors, it's a stark reminder that while conviction is vital, so is the capacity to adapt, reevaluate, and, if necessary, cut losses to preserve capital for future opportunities. In stark contrast to his losses, Ackman executed what he famously called the best trade of all time during the early days of the COVID-19 pandemic. In March 2020, sensing an impending economic shutdown and market collapse, Pershing Square purchased credit default swaps, essentially betting against the creditworthiness of corporate bonds. This prescient move, made with a relatively small initial investment of $27 million, rapidly paid off as markets cratered. Within weeks, the hedges generated a staggering $2.6 billion profit, providing capital to then invest in undervalued stocks. It was a masterclass in macroeconomic foresight and tactical execution. To appreciate the brilliance of Ackman's COVID-19 trade, it's crucial to understand credit default swaps, CDS. A CDS is essentially an insurance policy against a bond default. The buyer pays regular premiums to the seller. If the underlying bond defaults or its creditworthiness significantly deteriorates, as happened broadly across the market in March 2020, the seller pays out. Ackman's move was to buy protection on a basket of investment-grade corporate bonds. As the pandemic fears escalated, credit spreads widened dramatically, making his CDS positions immensely valuable. He essentially bought cheap insurance just before the house caught fire, then used the payout to buy assets at distressed prices. More recently, Ackman demonstrated his capacity for rapid adaptation, even if it meant taking a loss. In January 2022, Pershing Square acquired a substantial stake in Netflix, seeing value after a significant price drop. However, just 3 months later, after Netflix announced disappointing subscriber growth and a more challenging outlook, Ackman swiftly exited the position. He cited difficulty in predicting future subscriber trends and recognized that the investment thesis had fundamentally changed. This quick reversal, resulting in a reported loss of over $400 million, showcased a willingness to admit error and protect capital, contrasting with his earlier, more protracted battles. A hallmark of Ackman's strategy is his highly concentrated portfolio, typically holding only 8 to 12 positions at any given time. This approach fundamentally differs from diversification, which spreads risk across many assets. Ackman argues that true alpha comes from deep understanding and conviction in a few select businesses, rather than superficial knowledge of many. He believes that diversification, beyond a certain point, merely dilutes returns for those with genuine insight. While this concentration magnifies potential gains from successful bets, it also amplifies losses when conviction is misplaced, as seen in the Valeant and Herbalife debacles. Given the inherent risks of a concentrated activist portfolio, effective risk management for Ackman isn't about broad diversification, but about meticulous initial research and ongoing monitoring. Before committing capital, Pershing Square performs extensive scenario planning and stress tests. However, as demonstrated by the sudden collapse of Valeant or the persistent market disagreement on Herbalife, even the most thorough analysis cannot account for all variables, particularly human and regulatory elements. His COVID-19 hedge, though a separate tactical trade, also exemplifies a form of portfolio-level risk management, protecting the downside of his core equity holdings. While both Warren Buffett and Bill Ackman are renowned value investors, their approaches diverge significantly. Buffett prefers a buy-and-hold strategy, investing in great companies at fair prices and letting compounding do the work, largely shunning activism. Ackman, conversely, embraces activism, believing he can create value by improving companies that are currently underperforming or mismanaged. Buffett seeks economic moats and predictable cash flows, while Ackman often targets businesses with significant latent potential that requires hands-on intervention. Both aim for long-term value, but one is a gardener, the other an architect. A defining characteristic of Ackman's career is his unwavering conviction and his ability to articulate his investment thesis with exceptional clarity and passion. Whether it's a proxy battle against a corporate board or a public declaration of a short position, Ackman leverages communication as a powerful tool. He's known for lengthy, detailed presentations, often making his case directly to the public and fellow investors. This transparency, while sometimes controversial, helps rally support for his positions and pressure management. It's a testament to the idea that in investing, especially activism, the power of persuasion can be as crucial as financial analysis. Pershing Square Capital Management, under Ackman's leadership, has navigated significant market cycles, with its assets under management, AUM, fluctuating but generally remaining in the multi-billion-dollar range. While specific annual returns vary wildly based on the outcome of a few concentrated bets, the firm's long-term performance has demonstrated its capacity to generate significant alpha, particularly when its activist campaigns succeed. For example, Pershing Square Holdings, PSH, Ackman's closed-end fund, has often delivered double-digit annual returns over extended periods, reflecting the potency of his high-conviction approach despite the occasional, high-profile misstep. What can the everyday investor learn from William Ackman's career? Firstly, the paramount importance of deep fundamental research. Ackman's team delves into every facet of a business, far beyond headlines. Secondly, the power of conviction. Once a thesis is thoroughly vetted, the courage to make a significant, concentrated bet. However, this must be tempered with the humility to admit error, as demonstrated by his swift exit from Netflix. Understanding a company's intrinsic value, recognizing its potential for improvement, and being prepared to act decisively are central tenets of his success, even amidst significant volatility and public scrutiny. As markets become more efficient and information more democratized, the role of activist investors like Ackman continues to evolve. While traditional proxy battles persist, there's an increasing emphasis on collaborative engagement, focusing on ESG, environmental, social, and governance factors as drivers of long-term value. Activists are also leveraging sophisticated data analytics and social media to garner support. Ackman's journey reflects this evolution, showing that while the core principles of seeking value and driving change remain, the tactics and societal expectations placed on powerful shareholders are constantly shifting. His influence in shaping corporate governance is undeniable. William Ackman is more than just an investor, he's a public figure, a provocateur who isn't afraid to speak his mind or challenge the status quo. His direct communication style and willingness to engage in public debates have made him a polarizing but influential voice in finance. This public persona amplifies the impact of his activist campaigns, drawing attention to his chosen targets and sometimes shaping market sentiment. Beyond the trades, Ackman has also engaged in significant philanthropy, further cementing his broader societal impact. He represents a blend of shrewd financial acumen and a distinct, unapologetic public presence. William Ackman's career is a testament to the power and peril of high-conviction, activist investing. From the triumphs of Canadian Pacific to the humbling lessons of Herbalife and Valeant, and the timely brilliance of his COVID-19 hedge, his journey offers unparalleled insights into the intricate dance of capital allocation and corporate governance. He has consistently demonstrated that investing isn't merely about spreadsheets, it's about courage, conviction, relentless research, and the willingness to challenge entrenched interests. Regardless of individual trade outcomes, Ackman's impact on how we perceive shareholder value and corporate responsibility is undeniable, solidifying his place as a permanent fixture in financial history.